There's been a ton of Chinese buying. They like to gamble. It became very speculative. And I think that's a lot of what contributed to this huge run up to, eventually $110, $120. But it's kind of moderated now. I think we are in a bit of a consolidation phase, but none of the drivers, none of the fundamentals, and none of the economics, the macroeconomics have changed one bit. They've only gotten sort of more bullish. So I think we're heading higher from here later this year.
People that were sophisticated were selling futures, but futures were down 17% and they couldn't sell it anymore. COMEX was down 20, 25, 30%. So whether intentional or not, wink, the Western Hemisphere spoofed silver lower to get the buyers to stop buying over in China.
International silver prices have steadied after an epic bout of turbulence, but supplies in China are still being pinched as investment and industrial demand drain stockpiles. China is driving silver prices higher through intense speculative buying and fears of supply shortages following new export license requirements implemented on January 1, 2026. This, coupled with high industrial demand for solar manufacturing, has created a significant premium on the Shanghai Futures Exchange compared to Western markets. Silver specialist Peter Krauth and market strategist Vince Lanci bring together deep insights on the evolving monetary role of precious metals in today's increasingly volatile global economy. In this video, Peter Krauth emphasizes that his bullish silver outlook is based on supply fundamentals, not conspiracy theories. The silver market is hitting a physical wall. While Western ETFs like SLV have been quietly trending up since their mid-2024 bottom, the real price action is being driven by the East. It was aggressive Chinese demand that fueled the rally into the $120 range. We're in a consolidation phase now, but with inventories this low, the structural floor has fundamentally shifted. Despite the recent moderation in price action, Krauth predicts silver is likely to move higher again later this year as structural tightness reasserts itself. According to Peter Krauth, silver supply is falling 20% short of demand, while mine output is crawling at just 1% growth. This math has forced industrial players to secure physical metal directly, potentially draining the COMEX to the point of a delivery failure. If you're ready for unfiltered truth and sharp market analysis, hit that subscribe button. Let's explore the latest insights from Peter Krauth and Vince Lanci's recent interview.
No, I'm not a conspiracy theorist, but I have been saying for the past year and a half that was what was going to lead to what we just saw over the last, say, 3-4 months. And I think that's what happened. We saw by last spring, we saw the market come to terms with the fact that there is not enough silver out there, and that the only way we would get silver coming, any kind of even minimal relief was private holders selling it back into the market. And I said that wouldn't happen at $40 or $50. It was going to happen at $70 or $80. And to some extent that started to happen. But what's interesting too is that, there's all kinds of bottlenecks in the system. First of all, like you say, there's only so much silver on the major exchanges. For the most part, they've all been drained. We can see some of it's flowing into the silver ETFs. We've seen that SLV kind of bottomed. I think it was by the middle of 2024, and it's been trending up pretty strongly since then. And globally, silver ETFs have reached their previous peak, but the SLV has not. So what it suggests to me is that in the West, we haven't been participating quite to the same extent as they have in the East. There's been a ton of Chinese buying. They like to gamble. It became very speculative, and I think that's a lot of what contributed to this huge run up to, eventually $110, $120. But it's kind of moderated now. I think we are in a bit of a consolidation phase, but none of the drivers, none of the fundamentals, and none of the economics, the macroeconomics have changed one bit. They've only gotten sort of more bullish. So I think we're heading higher from here later this year. silver is not easy to come by. And if you've got big industrial consumers who are finding every possible way to get their hands on it, and if some of it is by holding long contracts, futures contracts, and waiting for them to mature to take delivery, and at some point, one of the major exchanges, I think it's maybe unlikely to be the Shanghai because it's built to be for delivery, whereas the LBMA and the COMEX are not. I'm not an expert in these markets, but that's my understanding, that it could be one of those two that fails, so to speak, and someone stands for delivery and they're told, sorry, force majeure, we we can't deliver, we don't have the silver, we'll settle you in cash. And they'll say, no, I don't want the cash, I want the silver. And that's when we're going to really hear that, and that could be, sort of the last straw. But you're right. The industrial demand is what has been, I think, essentially providing this rising floor under the silver price. And it's the physical, or I should say the investment demand, that really has come in a big way and has in the past been what has caused these spikes. I'm not even sure if this last spike was not a bit of both. I would think it was mostly investment that really caused it, because that's sort of, fast, I'm going to say dumb money in some ways. And people get caught up in this stuff, and they just, feel like, oh, I'm going to miss this boat. There's a lot of FOMO, and then they just keep buying and buying and buying, and then there's no one left to buy. And the smart money knows that it's going to correct. But yes, I think that can be a risk. The Silver Institute said that over the next 5 years, they expect ongoing deficits, and that we will actually see a new record deficit in the silver market. So it's not going away, and none of the projections I've seen for new supply coming from miners gives me hope for anything more than 1 or 2% growth in mine supply per year. That's nowhere near what the market needs. I mean, we're in a deficit of anywhere from 10 to 20% of annual supply. We're consuming 10 to 20% more annually than we get from mining and recycling combined. And Steve, I was looking at, there was an update from the Silver Institute back in November. So they put out their numbers every year, and that usually comes out in April for the year. They project what they think will happen for 2025, the last time around, the World Silver Survey. And then when November runs around, as most of the year has gone by, then they update their projections, and hopefully they'll end up being a bit more accurate. Well, what's interesting is that they show net investment in silver ETFs as a separate line item. So they show it separately from what they call the market balance, meaning surplus or deficit for the year. So what's interesting is that if you look back at the April survey, they thought that the investment into ETFs was going to be somewhere around 70 million ounces. And I remember saying at the time, that looks really wrong to me. I don't see that happening. I think we're going to see a lot more money flowing into the investment side of it. Obviously, some of it's physical, coins and bars, but some of it is into the ETFs that hold a physical. And it turns out that when they redid their estimates for 2025, that the flows into ETFs was going to be more like 200 million ounces. That's almost 3 times what they expected originally. And if you look at the market balance, including investment into ETFs, their estimate for 2025 is going to be an all-time high deficit. So this is a really, really tight market, and I don't see that improving. So the support for high prices is absolutely there. It's easy to look at a stock and say it's at $10. It's got a certain value, and it's hard to understand that if it's at $40, that it could actually be cheaper. But the way that we determine if it's cheaper is based on cash flows and profits. And what's interesting and what's important to keep in mind, and that's what I talked about at VRAC last month, is that analysts are not yet using, current silver prices. Up until a few months ago, they were using, if you look at the average of maybe the couple of quarters before, they were probably somewhere around the 25, 30, $35 range. They were a little bit generous, 40. When they start to revalue their models, they'll probably be more at maybe 50 or 55. We're at 70, $80. So the point is that I think what happens is when these silver producers report, they're going to be reporting their actual sales and their actual profits. They're not going to say, well, we sold at, estimate prices. They sell at market prices, average market prices. So last quarter, this quarter, next quarter, very likely these sales are going to be in the 70, 80, maybe higher dollar range. And they're all in costs are, you could argue, somewhere around, believe it or not, they've actually gone down. So for many, somewhere around the $20, $25 range, and they've gone down because, 3/4 of silver is produced as a byproduct. So if you've got a mine that, let's say, produces silver, and the other way around, if it's a mainly silver mine, but it produces byproduct, those are often used as credits and against the cost to produce the silver. And if those metals go up in price, that means you have even bigger credits against your production cost of silver. So your costs actually go down, and your revenues have gone up because the silver price has gone up. And I don't believe most of this has gotten priced in yet. We're going to start to see this happen, I think, over the next few quarters. And I think that's when the market's going to come to terms with that. And we're going to see, like you said, this $40 stock that is actually cheaper because at $40, the share price has not kept up with the increase in profits. That's the easiest way to put it. We've seen that with silver, we've seen it with gold, and so their actual valuations have gone down, believe it or not, with the much higher metals prices. So I think the story has been silver for the last sort of year and a half. I think the next opportunity in silver is going to be the miners over the next couple of years.
The silver market's historic sell-off since the end of January has erased most of the 61% gain made in the first weeks of the year. That rally was supercharged by a wave of speculative buying in China and elsewhere, as the white metal briefly overtook gold as a repository of fears over the dollar, the Federal Reserve's independence, and spiraling geopolitical confrontations. While silver was sliding globally, investors in China's only silver futures fund found themselves in a structural trap. Vince Lanci points out that a sudden change in valuation methodology, combined with Shanghai's strict 17% daily trading limit, effectively locked investors in as prices plunged 30%. While global markets like the COMEX stayed open, allowing sophisticated traders to hedge their positions, local Chinese investors were left watching the floor drop out from under them. Vince argues this was a systemic failure that exposes the growing pains of the Shanghai Futures Exchange. According to Vince Lanci, the rise of digital gold represents a structural pivot where the metal becomes the primary collateral for international trade. In a world of increasing financial warfare, Vince believes gold is the only trust anchor left that both sides can agree on. Let's jump into the interview.
China's Seoul Silver Futures listed open-ended fund dropped 31.5% after a sudden valuation methodology change tied to extreme global volatility. The adjustment pushed net asset values far beyond Shanghai's 17% daily limit lower, triggering trading halts and more than 17,000 complaints. The fund manager has now announced a compensation plan, fully covering small losses and partially reimbursing larger ones, in an effort to restore investor trust amid allegations of unfair advantage and short selling ahead of the reevaluation. Quick comment. See where it says a sudden valuation methodology change? That's when they halted the fund amidst the sell-off, because the Shanghai futures sold off more than 17%. But you couldn't trade it down more than 17%. It was only down 17% and stopped. Global silver was down 25, 28, 30% at one point. And so The stock fund only reflected down 17% and people couldn't get out. So the whole thing was rigged, in my opinion. The whole thing was the fund has too many longs. Let's change how the fund values things. And when we do that, let's create an opportunity for anyone to short silver as much as they want. I'm not saying manipulation. I'm saying asymmetric information about this fund having trouble was disseminated, and that was why the market was piled on. What they're doing here is when you step back and look at it in a geopolitical point of view, we're showing that the SHFE, Shanghai Futures Exchange, we meaning the West, is showing that the SHFE is not ready to go global yet because they have a 17% limit, whereas we have no limits. This is geopolitics. This is war. Next story. We sent this out yesterday. An individual gold standard is coming. That's our opinion. A new academic paper argues that tokenized gold, such as Pax Gold and Tether Gold, meets the functional conditions of a modern opt-in gold standard, backed by physical bullion, tightly tracking spot prices, and now integrated. This is what the paper found out. I'm not agreeing with it necessarily. Integrated into lending and settlement infrastructure, digital gold allows individuals to anchor their balance sheets to bullion without waiting for sovereign policy. The infrastructure exists. Adoption will determine scale. Historically, new gold vehicles have preceded larger bull markets. That's my opinion. The infrastructure exists. Adoption will determine scale. And historically, new gold vehicles precede larger bull markets. Now, comments on this piece, aside from the ones that agree with it, the ones that have a problem with it have a problem with Tether. Tether's not real. Tether doesn't have the assets. I don't care. I don't care. I don't care. The gold is being accumulated and it can't be rehypothecated. It will be rehypothecated. Don't get me wrong. Not yet, though. Not yet. And as they're accumulating it, people are holding on to their collateral. And so here's a message I have to that effect. I am here to tell you this is happening. There is nothing left for governments to agree on except gold for world trade. And therefore, either they get their people on a gold standard, even though they don't call it that, or there will be world war. That's where we stand. Gold is the only thing keeping trust together. It's becoming extremely obvious to me that there is a plan called, we call it ACD, ACD. A for accumulate the gold. C for collateralize the gold, something that Eric and I talk about all the time. And D, deploy the gold, distribute the gold. And in there, you're going to revalue it as well. That's where we stand. We're going to go more all in now. And on that note, coming out this morning, Tether now holds 125 tons of gold. That's actually low. It's 148 tons, ranking alongside mid-tier central banks and rivaling major ETFs in quarterly flows. This is a trading article. This signals a structural shift. Gold is gaining digital payment rails. Stage one is ownership. Stage two is monetization. As gold becomes collateral, early holders benefit from expanded financial relevance. What does it mean? Don't sell your gold. Okay, so we start with that fund. The SDIC, LOF does not mean long-only fund. You've heard me say that before. That's wrong. It's listed open-end fund. It's not a closed-end fund, but it's moving towards closed-end behavior. So here you have the fund. It's on the highs. And on the highs, hear me out. On the highs, the fund, the people running the fund, UBS, decides to change how they value it. And so that causes silver to drop. Silver didn't drop, causing that to freeze up. That froze up on the revaluation news, causing silver to drop. Silver drops 17% in Shanghai. They can only buy Shanghai futures. So they're limited to a local future. Meanwhile, on the COMEX, it was down 20, down 25, down 30%. Interesting, right? How it kept going down. But you can't get out of your shares. So you can't see it because there's the first day, they settled it, but it was trading below that. There's the second day, didn't trade. Third day, didn't trade. Fourth day, didn't trade. Fifth day, didn't trade. Sixth day, traded. They got their balance. What was that balance? That balance was everyone who wanted to sell silver sold it, and everyone who wanted to buy it back bought it back. And all these people could not get out of their positions because it was closed. Meanwhile, futures were selling off. So let's say you're a big hedge fund. I mean, you wouldn't do this, but let's say you're a big hedge fund and you were long this fund, this LOF fund, and you couldn't get out because the fund was closed. What would you do? You'd sell futures. So people that were sophisticated were selling futures, but futures were down 17% and they couldn't sell it anymore. COMEX was down 20, 25, 30%. So whether intentional or not, wink, the Western Hemisphere spoofed silver lower to get the buyers to stop buying over in China. That's where I stand on it. It's pretty brilliant. When you know that there's going to be a rule change coming and that information changes asymmetrically, well, that's how you do stuff.
A surge in retail and institutional buying has caused immense volatility, with investors buying up silver to hedge against economic uncertainty. If physical supply constraints and geopolitical realignments continue to intensify, are we witnessing just another commodities cycle where silver and gold reclaim strategic dominance in global finance? Let us know what you think in the comments. If this video brought you any knowledge, give it a like, subscribe, and ring that bell so you're always in the loop. See you in the next video.